Welcome to our channel, Muteki. Today, we're going to explore the fascinating world of ratio analysis. These tools help us understand a company's financial health. Let's get started. So, what is ratio analysis? Well, it's a way of taking numbers from a company's financial statements and comparing them to each other. This comparison gives us valuable insights. Think of it like a financial checkup for a business. Now, let's talk about liquidity ratios. Liquidity is all about a company's ability to pay its short-term bills. It's crucial because a company needs to have enough cash to keep running smoothly. As this slide says, liquidity is required for a business to meet its short-term obligations. And very importantly, liquidity ratios are a measure of the ability of a company to pay off its short-term liabilities. There are different types of liquidity ratios, each giving us a slightly different perspective. We have the current ratio or working capital ratio, the quick ratio, also known as asset test ratio, the cash ratio, also known cash asset ratio, or absolute liquidity ratio, and the net working capital ratio. We'll look at each of these in detail. Let's start with the current ratio. This table breaks it down nicely. Under description, we see that it's a measure of a company's ability to pay off the obligations within the next 12 months. This ratio is used by creditors to evaluate whether a company can be offered short-term debts. The formula is current assets divided by current liabilities. The interpretation is key. A higher current ratio, around 2, is suggested to be ideal for most of the industries, while a lower value, less than 1, is indicative of a firm having difficulty in meeting its current liabilities. Next up, the quick ratio, also known as asset test ratio. The description tells us it's to determine whether a company or a business has enough liquid assets which are able to be instantly converted into cash to meet short-term dues. The formula is cash plus marketable securities plus accounts receivable divided by current liabilities. And the interpretation, the ideal quick ratio should be 1 for a financially stable company. Now we have the cash ratio or absolute liquidity ratio. This is the most conservative liquidity measure. The description says it checks whether the company has the ability to clear off debts only using the liquid assets, cash and cash equivalents, such as marketable securities. It is used by creditors for determining the relative ease with which a company can clear short-term liabilities. The formula is cash and equivalent divided by current liabilities. Finally, let's discuss the net working capital ratio. This one helps us understand if a company has enough funds to keep operating. The description explains it's to determine whether a company has sufficient cash or funds to continue its operations. The formula is current assets minus current liabilities. Okay, so why do we care about all these ratios? This slide tells us why. It helps understand the availability of cash in a company, which determines the short-term financial position of the company. A higher number is indicative of a sound financial position, while lower numbers show signs of financial distress. It also shows how efficiently the company is able to convert inventories into cash. It determines the way a company operates in the market. And finally, it helps in organizing the company's working capital requirements by studying the levels of cash or liquid assets available at a certain time. Now, let's shift gears and briefly touch on leverage ratios. These ratios tell us about a company's debt. As the slide says, they determine an entity's ability to service its debt or long-term obligations. We have several types. 1. Solvency ratio. 2. Debt equity ratio. 3. Debt ratio. 4. Proprietary ratio. 5. Capital gearing ratio. 6. Debt service coverage ratio. 7. Interest coverage ratios. We won't go into detail on each one right now, but they're all about debt. Let's zoom in on the solvency ratio. This ratio, as we see here, reflects the firm's position and ability to meet the long-term and short-term obligations. If solvency is high, that means firms have sufficient resources to meet all obligations, and vice versa. A firm that is unable to maintain good solvency will find difficulty in paying debts and hence will get bankrupt. CALCULATIO and XYs. It's after-tax operating income total debt and also ratio of total assets to total liabilities. Uses of solvency include helps in identifying the sustainability of firm, helps in managing the assets and liabilities by striking the balance between assets and liabilities, and It guides in managing the various cash-related transactions. And finally, solvency versus liquidity. Liquidity measures firms' ability to deal with short-term debts, while solvency is related to managing long-term obligations. No standard ratio ideal. Higher the ratio, better financial position. Moving on to the debt-equity ratio. This ratio is super common. A higher debt-to-equity ratio indicates a higher proportion of debt financing relative to equity financing. It suggests that a company relies more on borrowing to finance its operations and growth. Conversely, a lower debt-to-equity ratio implies greater reliance on equity financing and signifies a more conservative capital structure. Ideal ratio, 2:1. For every 2 units of shares, there is 1 unit of debt. Okay, let's move on. Now, the proprietary ratio, ideal, 0.51. Higher the ratio, better. The long-term solvency, extent to which the assets of the company can be lost without affecting the interest of creditors of the company. Here we have the capital gearing ratio. This ratio compares the proportion of a company's capital that comes from fixed charge sources, such as debt, to the proportion that comes from equity. Let's discuss the debt service coverage ratio, or DSCR. As you can see, EBITDA, earnings before interest, tax, depreciation and amortization, is used in its calculation. Typical DSCR requirements usually range from 1.20x minus 1.40x. This ratio tells us if a company has enough income to pay its debts. And finally, we have the interest coverage ratio, or ICR. Again, EBITDA, earnings before interest and tax, is important here. Typical DSCR requirements usually range from 1.20x minus 1.40x. This ratio specifically measures a company's ability to pay the interest on its debt. Wow, we covered a lot today. I hope this explanation of ratio analysis was clear and helpful. Remember, these tools are essential for understanding a company's financial health. Thanks for watching. Mutechi, please like, subscribe, and share this video, and leave any questions in the comments below. Until next time, stay financially savvy. Perfect. I'm glad it's exactly as you want it now.